Hello, this is the lecture on the accounting cycle and completing the accounting cycle. So the lectures that you've watched prior to this were beginning the accounting cycle continued, and now the accounting cycle completed. So the learning objectives in this lecture are learning how to journalize and post adjusting entries, journalize and post closing entries, and prepare and post closing trial balance. Here's the steps to the accounting cycle's steps learned. Step 1 was business transactions occurred and you generated source documents. Step 2 is business transactions were analyzed and recorded in a journal. Step 3 was information was posted or transferred from the journal to the ledger. Then you created a trial balance in Step 4, a worksheet was completed in Step 5, and then financial statements are prepared. Step 7 is journalizing and posting adjusting entries. 8 is journalizing and posting closing entries, and then preparing the post-closing trial balance. These are great steps to put on flashcards if you're making manual flashcards. Let's go to learning objective 1. The information in the worksheet must be up to date. Financial reports give an idea of where the business stands. Adjustments have not been recorded into the journal or posted to the ledger, and books are not up to date or ready for the next accounting cycle. So you have this worksheet and you realize that you are able to see the big picture, but until you post everything back through your books, you are not current. The adjusting journal entries are the next part of the objective. Use the adjustment columns of the worksheet to prepare the adjusting entries. So remember, the point of the worksheet was to get yourself through balancing and understanding your financials, and at that point you can see what the month or the quarter of the year looks like, but now you want to take those adjustments from the worksheet and prepare the adjusting entries. The adjustments will bring the ledger up to date. Once posted to the ledger, the accounts will equal the financial statements, and updating must be completed before the next accounting period. Now keep in mind, if you're using a large accounting system, all of this is done through your accounting system. But remember, we learn accounting on paper like this so that the accountant can truly understand what they're doing. So here we are adjusting journal entries, looking at your worksheet. So remember, the adjustments ran all the way through the adjustment column. Now you're actually going to book those adjusting entries. So you're going to make your debit and your credit in your general journal and post it back to your ledger for all those adjustments. Now you're going to journalize and post closing entries. What is a closing entry? Well, every period that you have, your income statement accounts must be closed back through your owner's equity onto your balance sheet. Think of your income statement accounts as buckets that fill up and need to be emptied so that you can start over each period. So during this closing process, next period's transactions are made easier by this closing procedure. Closing is intended to close off the revenue and expense and withdraw the buckets that I was mentioning. And accounts have two classifications. They're temporary or nominal account and the permanent or real account. These terms are all used everywhere. I pretty much use temporary and permanent in my vocabulary. Recall that the expanded accounting equation had all of the owner equity pieces in it. So you had your assets equal your liabilities plus your capital minus your withdrawal plus your revenue minus your expense. These here are your owner's equity accounts. Your withdrawals, your revenues, and your expenses are called nominal or temporary accounts. These are the ones that need to be closed and then continued on to the next period. Their balances are not carried over, and the accounts are reset to zero for any new accounting period. There are 4 steps needed to journalize closing entries. You clear to zero the revenues through something called an income summary. The income summary is not an account per se in your books, it's a holding area. Then you clear to zero your expenses. Then you clear to zero the balance in the income summary and transfer it to capital. So first you put the revenue in income summary, then you net the expense through, and the net of that, which is net income, goes to capital. Withdrawals are closed straight to capital. They don't go through income summary because your income summary is your net income or net loss. Here's a nice little diagram, a visual. Revenue comes in, expense comes in, net income or loss comes out, and withdrawals go straight to capital. Closing entries are not adjusting entries. They're not the same thing. Closing entries are what you do at the very end. Notice here, here's your net income. So you can see here that the revenues go to income summary, the expenses go to income summary, and the net is net income. Withdrawals go straight through to capital. So here's a nice figure that shows some journal entries where the revenue goes to income summary. Income summary is a holding account. It sits, if you're using a computerized accounting system, it's not really an account, but this diagram makes it look like it has an account number. So in this example, it's a subset of the equity section of the chart of accounts. Then you put all your expenses through income summary. So here you see you're actually crediting all your expenses to clear them out. So they all have debit balances, and you're going to credit them to zero them out and put them through income summary. Here's a visual of a T account. This is where T accounts are very helpful. Now you've got your revenue and your expense in your income summary, and your net here is your net income. There's the $4,900. It's going to go from income summary, and you're going to put it into capital. Then you're going to close your withdrawals through capital. Now, I realize I click through these slides somewhat quickly. However, you feel free to watch this lecture as many times as you need to. And these are very useful slides. And here's a summary of your closing entries. So here's your revenues. Close your revenues. You debit your revenue to your income summary to wipe it clean. You credit your expenses to your income summary to wipe them to zero. Remember, expenses have a normal debit balance, so you're crediting them. Revenue has a normal credit balance, so you debit it. The net of these go to capital, and then you close your withdrawals to capital. Now you can prepare your post-closing trial balance. I like to say that if you can keep in mind that your post-closing trial balance is your little stubby trial balance, where all you see is the permanent accounts. The last step in the accounting cycle, this is actually the last step in the accounting cycle. See how stubby your little post-closing trial balance is? Because everything's been closed out. All that's on it is your permanent accounts, your assets, your liabilities, and your capital for the end of that period. So here is another slide. I'm going to post these slides on my website so that you can actually pull them down and print them if you would like to. Here's a summary of the chapter. I'm going to just say it in very short terms. The point of this chapter is to close your accounts for a period, and you always close a month, and then you can close a quarter, and you always close a year. But you really close every month so that you get that net income by month and you get that equity by month so that you can get a clear picture and a clean set of books for that period that you're reporting on. If you have any questions, send me an email. Like I said, I'm going to post these slides, and I will send an email out and let you know that they're posted. Thank you.